Using the Rule of 72, learn how to double your money. The Rule of 72 holds such significance that Albert Einstein himself considered it a more crucial discovery than his theory of relativity. Its origins can be traced back to Luca Pacioli, often referred to as the father of accounting, who first mentioned this rule in his 1494 book, Summary of Arithmetic, Geometry, Proportions, and Proportionality, emphasizing its importance. Doubling your money within a short span of time is a universal aspiration. How often have you wished upon a shooting star, yearning to wake up with a six-figure bank account? Well, I'm here to assure you that this dream can become a reality. In today's Practical Wisdom video, we will delve into the Rule of 72 and explore its incredible potential. Number 1. The Rule of 72. The Rule of 72 serves multiple purposes such as setting financial goals, analyzing economic trends, planning monetary objectives, evaluating investments, and managing debt. It assists in determining the time it takes for an investment with a fixed interest rate to double. To find the answer, divide 72 by the desired rate of return. For instance, dividing 72 by 5 gives a result of 14.4, representing the number of years needed to double your money. This rule offers several benefits. It provides a quick assessment of whether you are keeping up with current trends and making wise financial decisions. Additionally, it can be used to calculate inflation by determining the number of years required for the initial sum's value to have instead of doubling. However, there are certain drawbacks to consider. The rule is applicable only to assets that generate compound interest on an annual basis and has limited accuracy for interest rates below 6% and above 10%. Despite these limitations, it is advisable to consult with a financial advisor to gain a deeper understanding of the Rule of 72 and receive appropriate guidance. Number 2. Compound interest. As mentioned earlier, the Rule of 72 specifically applies to compound interest. Understanding this rule and the potential of compound interest is key to achieving financial growth. Now, let's explore compound interest in more detail. One remarkable aspect is that the longer you leave your money invested, the greater your earnings will be. Essentially, the interest earned on your initial investments is added to the principal amount, creating a continuous cycle of growth. In other words, you invest your money and let it grow over time. To determine how long it will take to double your current savings, you can use the Rule of 72. Take the interest rate, for example, 6%, and divide it by 72. Dividing 72 by 6 gives a result of 12, which represents the number of years it will take to double your money. When dealing with compound interest, it's advantageous to aim for higher interest rates as they expedite the doubling process. Consulting a financial advisor is recommended to explore the best compound interest options and utilize the Rule of 72 effectively to accelerate the growth of your bank balance. Number 3. Investments. The Rule of 72 is a useful tool for appraising investments and determining how long it takes for investment to double. To apply it, first calculate the estimated annual interest rate or rate of return on your investment and divide 72 by that figure. For example, dividing 72 by 6 gives you an estimate of how long it will take for your investment to double. Remember that the Rule of 72 provides an approximation based on compound interest. It can be used to any sort of investment, such as savings accounts, bonds, mutual funds, or stocks, as long as it generates compound interest. Keep in mind that the Rule of 72 may not be accurate for interest rates significantly below or above the typical range of 6% to 10%. Consider seeking guidance from a financial advisor for more precise insights tailored to your specific investments, helping you make informed decisions. Number 4. Inflation rate. You may have come across discussions about inflation lately, but what does it really mean? Inflation rate refers to the pace at which prices generally increase over a specific period. It affects everyday goods and services, including essential items like groceries. Put simply, it implies that the cost of purchasing the same item as last year will be higher. The Rule of Savatitude provides a useful tool for determining how long it will take to surpass inflation. For instance, if the average annual inflation rate is 3%, a quick calculation using this method reveals that prices will double in approximately 24 years. However, if the current inflation rate remains at 6.8%, dividing 72 by 6.8 gives us around 10.6. This suggests that prices will experience a significant surge in just 10 years. By employing this guideline, you can proactively manage your finances to stay ahead of inflation and mitigate its negative impact. Number 5. Savings. The Rule of Savatitude offers several advantages, particularly when it comes to estimating the time needed for your savings to double. When considering where to keep your savings, what options come to mind? Do you keep cash at home? It can be risky and easily lost. Are you thinking of investing in the stock market? While it offers greater potential for returns, it also carries a higher risk of losses. Perhaps opening a savings account at a local bank is an option. However, this typically comes with lower interest rates, usually around 1%. It's commendable to save money and create a budget, but it's equally important to understand the doubling time for your investments. Let's explore some examples of the rule in action. Divide 72 by the interest rate to determine the doubling time for investment. For instance, suppose you have $1,000 to save in a bank account with a 1% annual interest rate. Dividing 72 by 1% gives us 72 years. This means that if you invest $1,000 now, it will take 72 years to reach $2,000. However, it's unlikely that you will be around in 72 years to enjoy a $1,000 profit. Fortunately, there are investment plans that guarantee a minimum annual return rate of 4% to 7%. By conducting research and consulting with a financial expert, you can discover more advantageous investment opportunities. Let's revisit the previous example. You still have $1,000, but you invested in savings program with a 5% annual interest rate. Dividing 72 by 5 gives us 14.5 years. Instead of waiting 72 years, it will only take 15 years, regardless of the initial amount, to double your investment. Moreover, this option is safer. Remember that 5% is just an example, and actual interest rates can be much higher. We hope you found this video educational and helpful in understanding the power of compound interest and how to apply the Rule of Savatitude to your financial goals. Remember that the Rule of Savatitude can be used to calculate the time it takes for your investments to double dependent on the interest rate. It's a useful tool for assessing investments and making sound financial decisions. If you liked this video, consider leaving a thumbs up and subscribe to our channel for more information on personal finance, investing, and wealth building tactics. Don't forget to leave your opinions and questions in the comments box below. We enjoy hearing from our viewers and are here to help you along your financial path. So stay tuned and keep doubling your money with the 24-hour rule.